Last month, I did a video on 2 undervalued dividend stocks to consider. I got pretty positive feedback. A lot of you enjoyed this video, so I decided to do another one for this month of 2 undervalued dividend stocks that I'm seeing in the market. And many of you requested me to talk about different stocks than the ones I usually talk about. Now, the main reason I most of the time talk about the same exact stocks is because I am not seeing a different opportunity in the market. If I see a better opportunity, then I'm gonna go there. If I don't, then I'm gonna just stick with the best possible option. But in this video, I decided to include one name that I've never talked about. I think it's a undervalued blue chip dividend stock. It's a pretty controversial stock because a lot of people love it. They love the company, they love the product, and they think it's just amazing. But a lot of other people, they believe it's extremely overvalued. It should be trading at 10 times earnings, and it's just a trash company, overhyped from COVID or whatever it is. So it's gonna be a pretty interesting video. I really hope you enjoy it. Now, this stock that it's pretty controversial, and I didn't know that before I posted on Twitter, and it's actually Coca-Cola stock. Now, before you click out of this video, I hope you're gonna give me a chance for me to explain to you why I believe Coca-Cola is somewhat undervalued here in the video. But the company has been crashing. The stock actually is sitting at $53 per share. This is pretty much flat from the 2019 level. It even touched around $51 per share. A lot of other, staple company, pretty safe companies, dividend stocks, they've been crashing. McDonald's is down 11% almost on the month. This is not common. Coca-Cola is down 9% on the month. PepsiCo is down again around 9% on the month. This is pretty, rare in my opinion. It doesn't happen very often, especially when you have these stocks going down, but everything else, like maybe the AI stocks or Nvidia, either flat or going up. It's been pretty interesting. But one of the most interesting setups of all is what happened on Friday whenever the whole news came out from Walmart blaming, some kind of a slowdown on the Ozempic pill for weight loss or whatever. And on this news, it was insane. I mean, I couldn't believe what I was saying. Coca-Cola crashed 4%, Pepsi crashed 4%, a Costco stock crashed like 4 or 5%, and the stocks that I talked about, BJ's Wholesale Club, was down like 3%. I mean, I couldn't believe what I was seeing. It was absolutely insane. To me, this is absolutely ridiculous. I think Walmart is just, trying to blame a slowdown or something. I think this is just a slowdown because there's no way in the world that, this whole Ozempic pill is really affecting, people buying food or something. I mean, I personally don't believe it. And if it is, it's not going to affect them to the magnitude of the sell-off where Costco sold off 4% just because of this pill. I mean, people will not keep taking it forever. To me, it's an insane situation, massive overreaction. I mean, I couldn't believe it. I mean, it was an opportunity for me to add a little bit of the stocks that I own in my portfolio that are around this industry. I mean, it's pretty funny to me. People believe that stuff, and then people talk about it. YouTubers talk about it. The story gets bigger. And I mean, to me, it's just an overreaction. I mean, I don't believe it's such a big deal as people are talking about. And if you look at Coke, most of you are familiar with the company. They don't only have Coca-Cola, but they also have, Sprite, Fanta, and they have a lot of water stuff, Powerade, and they also have a stake in Monster beverages. They have other juices and stuff, and some, beers, and a few other things. So Coke is highly concentrated within, the drink industry. But a lot of you know what Coke actually has, but you don't know how Coke makes money. You believe that Coke makes money by just increasing the price of a can of Coke or soda or whatever, and this is how they make money. Well, this is not true. Coke does not control the price of the can that you buy at the store. This is the bottlers. The bottlers are separate businesses that you could actually buy a stake in. I used to own a bottler, and I was stupid enough to sell it. It's one of the best business models in the world. But what Coke is responsible for, they are responsible for the concentrates and the syrups. They sell the syrups to the bottlers, the special, syrup for the Coca-Cola. And the bottlers, they make the bottle, they make the design, they set the price, they do the distributions, they do all the work. Coke only focuses on giving them the syrup. And every year they hike the price of the syrup, and the bottlers control the margins and whatever they charge for a can of Coke at the store. So this is how the business model pretty much works. And this is why Coke has very high margins. They have over 26% net income margin for Coca-Cola. This is a tech company kind of margins. A lot of tech companies, software companies, they don't have 26% net income margins. But because the business model is so amazing, it's so simple, they just focus focus on the syrups, and they hike the price of the syrups. They send it to the bottlers. The bottlers do all the work for them. It's a pretty amazing, pretty high quality business model. If you look at the price to earnings ratio for Coca-Cola, it's actually now a little bit lower. It's sitting at around 19 times earnings, but ticker takes a little bit of time to update it. So it's sitting 20 to 19 times earnings. Now 20 times earnings, if you want to take it, this is, if you look where it was, this is pretty much where it was crashing at in March 2020. The mean over the last 5 years was 24 times earnings. The highest was 27, and now Coke is trading a little bit below 20 times, or around 19 times earnings. So it's much, much lower than the historical average. This is for very good reasons. The first reason, in my opinion, is that investors are not focused on safety. You always have sector rotations, which I talked about in my video. Sometimes investors feel too optimistic. They go into Nvidia, they go into Palantir, they go into AI stocks, and the money goes there, but it comes out of somewhere else. It comes out of Procter & Gamble, out of the defense stocks. The defense stocks are down 20 to 30% year to date. They don't want any safety anymore. They don't want a recession-proof company or a dividend payer. They just either put them in treasuries, collect 5.5% or 5%, or they take some risk and go into Palantir and Nvidia. And this is, what's been happening in the market. If you noticed, Nvidia and Palantir and other AI stocks, they've been pretty strong, but the entire market has been crashing. High quality blue chip stocks like McDonald's, Coca-Cola, Pepsi, Procter & Gamble, utility companies, and many others. Although utility companies have some debt, but a lot of high quality companies, most with pretty wide margins for the first time ever, I'm starting to see double digits returns on them. And I'm getting very, very excited because I don't normally buy mega caps or large caps. I buy small caps to mid caps, but now it's changing. I'm pretty excited. It's sitting, much lower than the mean multiple, around the high 19 times earnings. The company does not have any crazy amount of debt. They have 12.5 or around 14.4 billion in cash and cash equivalent. The long-term debt for the company is something like 35 billion. So they can, they pretty much cover half of that. And they also have massive free cash flow. The dividend payout ratio it's not too crazy. It's something like, 50% or 52%. So it's nothing to worry about. But the main way I look at Coca-Cola for potential returns. Now, this is, again, a very large company, but it's still growing 6 and 7% EPS. And they were able to hike it a little bit more actually in 2021. But it's still growing EPS 6 and 7%. And if you believe we're going to have higher inflation in the future, you bet that Coca-Cola and the Coca-Cola bottlers are going to do amazingly well. And Coca-Cola actually owns a 20, 30, or 40% stake in many of the bottlers that do the bottling for Coca-Cola. So if you believe we're going to have higher inflation, Coca-Cola should be able to raise the EPS much more. They pretty much always beat, they rarely miss. So I would not be surprised if the EPS estimate here is conservative. So I see around 7% in terms of EPS growth, which is alone matches the average return of the S&P, 7 to 8%. I'm also seeing a dividend. The dividend for the company is something like 3.2%. It's not the highest dividend in the world. I would not be surprised if Coke gets to 4%. It has marked a historical bottom. Whenever Coke gets pretty close to 3.5%, I don't know if it's going to 4%, but 3.5% has actually marked, a historical bottom on Coke. It's been pretty much the peak, but 3.2%, it's not bad for a blue chip, high quality company. I see, as I said, around 7% of normalized EPS growth every single year. And I also see a potential for a multiple normalization where Coke goes from 19 times earnings, it bounces back to around 22 to 24 times earnings. So in total, looking at everything I'm showing you with the EPS, the dividend, a potential multiple expansion, I'm seeing double digits returns potential with Coke, maybe 12 to 30%, could be even closer to 15% if Coke keeps going down and the multiple gets even lower. Although Coke bottomed at 17.5 times earnings in March 2020, and now it's pretty close to 19 times earnings. So this is pretty crazy, while the S&P is still holding up. This is what's happening because of the Magnificent Seven and the AI stocks. But I'm seeing double digits potential return with a very safe company with very little risk, with a company like Coca-Cola. A lot of people like the dividend. The dividend, they increase it like 3 or 4%. It's nothing crazy. It was 76 cents since 2008. Now it's $1.76. So it does go up over time. I'm not a dividend investor, but a lot of people like that stuff. And for the risk, I am seeing a pretty decent reward opportunity with a company like Coca-Cola. Now, the second stock that I talked about before, this is an update. I still believe it's dirt cheap. It's extremely undervalued for the quality of the assets that they have, for the quality of the company and the management. And this is MAA, which is Mid America Apartment Community. This is a REIT that's mainly focused in the Sunbelt area. This is the best area to be in. A lot of people told me, don't you get worried that the company is just too concentrated? I'm like, this is the best area to be in. Where do you want to be? You want to be in New York, where people are moving out? You want to be in California? People, they just don't want to live there. They're moving out of there. They have a net migration out. They're going out of there, and they're going into Florida. They're going into Texas. They're going into Nevada and Arizona and Texas and Georgia and many other places, North Carolina, South Carolina, Tennessee. This is where Mid America is focused on. It's focused in the high growing area, high migration areas, and because they are focused over there, they can actually raise rents much more than another REIT being in a different area. You look at the rent growth, it has averaged around 7.2%. They raised rents even in March 2020. Whenever you had this whole thing, they still raised rents 2.6% in this area. They raised them in 2021, 5.2%. In 2022, they raised them 14.6%. In 2023, they're going to raise them another 7.3%. And the average has been something around 7.2%. This is what I love, that Mid-America can raise rents every single year 7.2% without them having to dilute stock, to do acquisitions, to increase the FFO. This is what most retail REITs own. And I'm pretty bullish on O, so I'm not putting O or VC or the other ones down. But O and VC and many others, they have something like a 2 or 3% rental increase every single year for the triple net. Well, Mid-America can raise rents 14%, they can raise them 5%, so they can grow 5 to 7% without any acquisitions. If they do more acquisitions, then this is a plus. And this is why the shares outstanding have been so stable for apartment REITs like Avalon Bay Communities, like Mid-America. They don't need to go in the open market to raise. They can just take loans and build the apartments, increase the rents whenever you have higher inflation, especially if you're positioned where Mid-America is positioned in. This is the best place to be, in my opinion, in terms of either buying a physical property or even just buying REITs, which I believe they're offering a pretty good investment proposition here. And if you look at the occupancy rate, it's always averaged 95%. It's still at 95%. I mean, pretty amazing stuff for the company. You look at the debt, they don't have any crazy debt maturities. Most of them are, sustainable. The company can pay it off using the FFO from the operations. You look at the debt, it's 100% debt fixed rate at 3.4%. So the, balance sheet is pretty good in my opinion. It's not the best in the world, but it's pretty good. I don't think they're gonna need to refinance or do anything crazy in the short term. If you look at the dividend was pretty low at 1.7% because the company is growing, and now is sitting around 4%, which in my opinion, it's providing an amazing value proposition at 4%. Yes, it's much lower than something what you get in the treasuries and stuff, but you cannot just compare every single company to a treasury. So if you have something like a company at a 4% dividend and it has 0% growth, then you could say, why would you buy it? You just put your money in T-bills. But if you have a company that's growing 7 to 10% and is paying a 4% dividend, you just cannot compare it to the 10-year. This is the way I personally think about it, because in a year or two from now, it's going to be much higher than the 10-year, and who knows where the 10-year is going to be. But the dividend is pretty well covered. They have over $1 billion of funds from cash from operations. In terms of dividends, they pay $543 million. So this is a 50% pretty much payout ratio, and they just have a little bit of capex, nothing crazy, but then they can take the rest and pay down the debt, which is why I'm not worried about the debt at all. If you look at the multiple of the company, it's now sitting at 15 times AFFO per share, which is at March 2020 multiple, much lower than it was ever before. I mean, the lowest it was something in 2013 or 2012. Even if you look at the stock chart, the price is sitting at what it was pre-COVID, yet rents are much higher than they were pre-COVID. The apartments, buildings that they are having, they are worth much more than they were pre-COVID. Apartments and everything is just much more expensive. The stock is trading, I mean, it's pretty much getting closer to where it was trading at in March 2020. I mean, it's pretty crazy, but the multiple is much lower than the historical average. The historical average is closer to 19 times. Now the company is sitting at 15 times. So we have a multiple expansion potential back to the mean. We also have, something like a 4% dividend, which is growing rapidly. Next year is going to be around 4.5%, which is not bad. And you also have a company that's massively growing FFO per share without having to dilute any stock. If you look at the previous growth, it was massive, 30%, 35%, 47%. But from 2015 to 2019, it has been around 14%, 90%, 21%, 9%. The lowest it had, outside of March 2020, it was around 9.2%. So if we take 9 or 10% FFO every single year in terms of growth, which I personally believe is possible, unless we have something with high inflation, maybe inflation reaccelerates in the future, then MAA is going to be growing 21% or 22%. But I would assume something like 7 to 9, even 9 or 10% FFO growth every single year. I see a 4% dividend, and I see a potential multiple expansion. So in total, I would say something around the 15%, in terms of return every single year, which is a double every 5 years. I would not be surprised if it's much, much higher than that, especially of the multiple expansion. And it's very hard to determine what the FFO growth is going to be, because it depends on the rents that they're going to be able to increase. And it also depends on the acquisitions or, whatever they build up and whatever they be able to rent, when do they complete the projects. So it's very hard to determine. But I would say, looking at a historical basis, 9 to 10% has been a safe bet with MAA and with a 4% dividend. And you also have a potential multiple expansion well below the mean, trading at its March 2020 kind of multiple. I see a lot of upside potential with MAA being positioned in a pretty well diversified area, in a high quality area in the Sun Belt. So I really like MAA. I think it's much more undervalued than Coke, but I see Coke as a much safer bet than MAA. So this was my thoughts on those two undervalued dividend stocks. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.